private money, hard money lending, non-QM loans. What is the difference? Everybody has heard of the traditional 30-year fixed conventional financing, right? This is Fannie Freddie financing. It is based on very stringent, very traditional guidelines as to how to qualify for a home loan. Typically, government-backed financing, 42 to 45% debt to income ratio based on very basic criteria: how much you make on your W-2 income, how much you show on your if you're self-employed, on your adjusted gross income on your tax return. And those loans are fantastic if you can qualify for them. Now, what is hard money financing versus non-QM? You might not have heard of non-QM, but let me explain that. Hard money is hard money, right? It is the hardest thing to get. Not necessarily. It is definitely the most expensive thing to get. So let's say you cannot qualify into conventional financing for the home that you want, but you can show that you're willing to pay a higher interest rate and you have a certain amount of down payment that will satisfy a hard money lender. Hard money / private lender is somebody who's going to look at this deal and say, is there enough rate of return to justify the risk of lending to somebody who cannot qualify conventionally? That's fair, right? They may charge in this marketplace, north of 10% or 12% to give you that loan, when conventional financing might be in the 6s and 7s, right? So is there benefit to the risk of somebody doing that? Great. Hard money is out there. Not suggested. It is, an alternative if that's all you can achieve. And if for you getting that for maybe a short-term time frame makes sense, right? The middle of that, the in-between of conventional financing and hard money financing, is called non-QM. Conventional financing is a qualified mortgage based on certain qualified standard criteria. A loan that does not fall into that criteria and is qualified is a non-QM, not qualified. So it does not fit that Fannie and Freddie guidelines of a standard qualified mortgage. But these loans are absolutely helpful if you do not qualify for conventional financing and you don't want to go the route of private money or hard money financing. Right. So as alternatives to this, let me give you an example. One non-QM loan that a lot of people use is if they're self-employed, so they don't have a W-2 income, and they may not be showing enough income on their adjusted gross income on their tax returns based on, expenses that they take for the business. But let's say you own a business that makes a significant amount of revenue, but at the end of the day, less expenses, you don't have enough net income to qualify for a loan. You can qualify for a non-QM loan based on the gross income that you receive for the business. So they'll look at the monthly sales that come in, the monthly revenue that comes in, and there are non-QM lenders out there who will say, okay, based on this gross income of the company that you own, you can qualify for a loan. Alternatives to that, let's say you have a job, you don't make a lot of money to qualify for the home that you want, but you may have a lot of liquid assets in the bank. An inheritance, you've built up a 401k, you've built up a stock portfolio, and after the down payment, you may have a significant chunk of money there that money, not necessarily to pay for the loan, but that money can be used to qualify for the loan. So one wholesale lender that we use will take an 84-month period of that money to qualify you for the loan. So let's say in this case, after the down payment, you have $500,000 in the bank, and if you take that over 7 years or 84 months, that works out to be about $5,900 in income that you can use to qualify for your loan. So you take that $5,900 plus whatever, say, your W-2 income is, and put those together to qualify for a loan. A third alternative, on investment property, let's say you don't qualify for your overall universal income to qualify to buy an investment property, because lenders will typically only give you 75% of your rental income to qualify. So you cannot qualify on a dollar for dollar basis. But if you just look at the property and the property will rent for, say, $5,000 a month, a lender, many of the lenders that we have wholesale relationships with, will give you that $5,000 as offset on a 100% basis if you need to qualify for the purchase of that property, looking only at predominantly the rental property. So let's say you have personal debts and other income that may not help you qualify. A DSCR loan will look only at that rental property. So that could be a very useful solution in the right scenario. Now, obviously, we want to pair, can you qualify conventionally as a primary objective? Can you qualify non-QM as a secondary objective? And do we look at hard money as a third objective if necessary, right? So that's what we're here to do. I'm Mario Pinedo. I'm a mortgage broker in California. I cover all of California. We have wholesale relationship lenders who give us alternative financing and conventional financing to help you achieve what you want to achieve. So give us a call. Let's talk. Let's figure out your scenario. Let's either get you moving today or get you a plan for the future. Talk to you soon. Thank you.